We're in conversation with Manish Kejriwal, the founder and managing partner at Kedaara Capital, one of India's largest private equity funds. Manish, let me start with the macros. We heard President Trump last night take charge, read out, one by one, sign off on so many executive orders that's going to have a huge second order impact, whether it's on climate, whether it's on tariffs, etc. What do you make of this new world that we're going to be living in?
Firstly, thanks for having me on. Chandra, this is unique Davos. It's probably the warmest Davos that I've ever been to. Hands, no gloves. Yesterday, we were walking around even without the heavy jacket. You hardly see snow. So I think the reality is maybe this is global warming. Maybe what Trump is doing on a few things like the climate initiatives, maybe a negotiating posture. Listen, the two things which have dominated discussion the last 2 days, one, as you all expected, was AI and artificial intelligence. The second has been the global geopolitical order, especially with Trump's new moves. I think we've got to watch carefully the next 100 days or so to clarify. But I do think when I look at the rash of orders, starting from some of the stuff, which is the forgiving broadly of more than 1,000 people for what happened in Jan 6th 4 years ago. That was sad, but not unexpected. Whereas some of the other stuff is probably very practical from the lens and context of the leader of the United States. So I think when I keep telling my son, when we graduated from college, the world was expanding and we were going multipolar. The wall in Berlin, the Berlin Wall was falling, glasnost was happening. It seemed like a world was coming together. Now you're going from multipolarity to unipolar, and you're seeing people protect their own fiefdoms. And the U.S. is a classic example. If you look at what he's doing in terms of trade, whether it's you're going to have 25 or 50% taxes with Canada and Mexico, probably unrealistic. But that's the shot he's throwing across the bow as a warning shot. And the reality will be a little bit more realistic, but it will be more inward looking. So I think all trade partners, including India, should be careful of that, number one. Some of the social stuff, the stuff that he's doing across, such as work from home, canceling that at least for the federal workers. I mean, that's some in the private sector, like Jamie Dimon have been saying for a while in the private sector also. So I think broadly, none of these is a surprise. The question that we need to be careful about is how much of this is a negotiating stance and a bow across, sort of a shot across the bow, or is it what they really mean?
Right. Zooming out from the US to India, Manish, we are days away from the budget. And in the last few weeks, the theme has been around slowing GDP, weakening consumption. What should the government do?
You know, I am never, and I've been on record in saying this earlier, a believer in these annual budgets. I think as a country, historically we put too much attention. And you can't have a government or a polity or a people where you are zigzagging every year. I think what's needed, and I think what this government has done, has given a broader 5-year or a 10-year perspective, which is around growth, around focus on infrastructure, on creating jobs. So in my mind, what they have done broadly in the longer term is the right direction. Now, when you have challenges in the global economy, as we do, we're relatively much better off. At least we do have growth. Okay, it's not the 8% growth we might want. It's maybe 5.5 or 6%. We've seen some weaknesses of that, maybe in, especially recently. But a lot of those weaknesses, Chandra, as you're aware, is probably because of what happened right after COVID, right? When you had to have COVID, you had a dramatic jump in consumption. That dramatic jump in consumption, if you see, for example, we have a lot of housing companies. Yeah. The average size of a mid-size house has actually increased as people wanted more space given what they got used to in COVID. The actual reason for this has then been a dramatic increase in interest rates. So people paid more for their houses. They also had to pay more for a larger house and a higher interest rate. That took away the EMI payments for that, took away from their household budgets. And that you're seeing in the last 6 months. But like everything else, Chandra, this is a cycle of life. You probably had a few excesses. You had high interest rates. The government should do what they can to control that. But consumption will come back. We eventually, if you look at India as a market, and you know the numbers better than I do, the India story and the growth story is a secular one. And every vertical, every way you cut the market, the level of consumption or a per capita consumption in each sector is so low that there's so much unmet demand. There might be a period of slowness, but that will come back.
Right. Manish.
And what the government should do is really focus on what it's paid to do, which is focus in the long term, focus on infrastructure development, focus on job creation, and be supportive of industry. And I think this government is doing that extremely well.
Right. Talking about Kedaara, you raised a record 1.7 billion fund in the middle of last year. It was one of the biggest fundraisers, in the Indian PE landscape. Tell us about deployment. Where is this going to go? Do you have a target for 2025? What are some of the themes that you've picked out? I think we recently saw big AI investment from your portfolio a few days ago.
Yeah.
But, what themes do you like?
Yeah. Let me first clarify. The fundraise was actually done in the first 3 months of the year. And not only was it the largest fundraise in India at that time, it was also the shortest amount of time. We raised that in 3.5 months when the global challenges were extremely high. And that's a testament to the team at Kedaara and what we've done and what the LPs trust in us as an investor in India. And we also actually had demand exceeding the 1.74 billion, was actually north of 2.5 billion. But I'm one who always believes that there's no point raising a large fund just for fees. It's better to raise a fund where you don't have pressure of deployment. You make the funds and you come back earlier. So you deploy the 1.75 in 3 years instead of 2.5 billion in 5 years. And so when you come back, you can then distribute carry to your team a lot sooner. So that's why, even though the demand significantly exceeded $2.5 billion, we kept it to $1.74 billion in order to keep it at reasonable size. Your second question on what to deploy in, I'll be proud to tell you, given where valuations were last year, and we're seeing the starts of a correction. I don't know if this is going to be a permanent correction. This morning, the last couple of weeks, the markets have been weak. And the private markets are eventually a follower to what the public markets do, right? When it's going up, the private valuations go up. When it goes down, expectations come down. So in the last year, actually, I was one where me and my partners, meant a very disciplined approach to new investments. And we were focused more in creating DPI. DPI is exits. We've had a couple of extremely successful exits, the most recent being the listing of Vishal Megamart, which was done in December. Well, there are 3-4 more in the outlook in the next month. It's I always never consider it good luck by mentioning it by name until it actually happens, because the Indian market is so volatile, and you can't ever take SEBI for granted. SEBI's been extremely supportive. We've had a bunch of very successful IPOs during our history. The last one has been. So to your question on deployment, our focus last year had been more on exits rather than new investments, just given the valuations. And what happens in situations like this is you try your best then to deploy capital. When you're giving it at these valuations, you have zero room for error. So you've got to make sure your levels of confidence in the companies you're deploying money behind is extremely comfortable. So actually the last 2 deals we've done has been in the vertical around tech services. AI, the one you mentioned, is a company called Impetus. We did that recently. But if you look at the sector as a whole, compared to consumer, which is what Vishal exit was all about, the valuations are much more realistic. The multiples are much more realistic. So we've spent a lot more time during the last 1 year in businesses, which have lower multiples, and broadly the whole sector is this way, but also those given where the volatility of the rupee has been, which are the revenues in dollars. So there's a natural hedge to the rupee's depreciation. And I'm proud to say the 2 investments we've done are both in leading companies. We have very high confidence in the management teams. And the last one around the company that does the AI is obviously an extremely strong platform for both data migration and AI. Cutting edge team, 2 Indians who co-founded it, have been running it, and we've come in to support them. and have taken a controlling stake in the company.
Right. What other investments can we expect going forward, Manish? What themes are you looking?
You know, our approach, Chandra, is both top down and bottom up. We spend a lot more time as a team really understanding, comprehending, developing certain themes where there is a Kedaara angle, where we can provide value, where we think we have a better understanding than the next guy. We also go bottom up in terms of seeing what's actually out there in the market. It's not just conversations with bankers that we obviously do, but we also do a lot of sourcing ourselves. Majority of our deals, almost 70% are proprietary deals. So when we understand, just to give you an overall sense, a particular theme or a vertical that we like, our teams then go out and scour the entire market for everyone which is in that field, whether there's a deal or not. Because success not being a deal in the next 6 months. Success is doing a deal over the course of a fund or the next fund, growing the company, adding value. We've just dramatically increased the quality and the size of our operating partners. How they work closely with our investee companies to create value and then exit is the Kedaara model. And having an angle where we can provide superior value addition or get it. So either we can provide and create a growth stage in the company and higher profitability than it would be done without us, number one, and or be able to come in cheaper than what the deal would get done. Otherwise, why is Kedaara the preferred investor in these companies?
Right. You mentioned Vishal Mega Mart, Manish, which was a great outcome for you. Do you expect similar players with a tier 2, tier 3 market focus, to induct PEs and accelerate growth?
You know, I think historically the bane in private equity had been that we did not add value as an industry. I'm looking internally now. So I think you can't take a categorical approach and say all companies looking at tier 2, tier 3 cities. Vishal was a unique example where, yes, it tapped into that market, which was primarily tier 2, tier 3 markets, affordable. The average price of a shirt was 199 rupees. The highest cost of a shirt was less than 1,000 rupees. Yeah. So it was extremely affordable. It's not what you would call the bottom of the pyramid, but the bottom half of the pyramid is what we focused on. And that demand is exploding. But I think the returns were there not just because of the market. The market's going to be there in India, as I said earlier, in every segment. It's what you do. How do you enter that company? What do you do with the company? What does your investment team do? What does your operating team do? How do they add value? And then how do you decide to exit the business? In our particular case, you can have a strategic exit. You can have a sale to another sponsor. You can sell to an IPO. Given that it was almost a perfect confluence of items which happened, where we had in GK Kapoor, probably the best management team he had built up. We had a controlling stake in the business, so we knew what we could do with it. And we picked a time to exit, which is probably the most attractive with the public market. And remember, we only sold 20%, Chandra. So we still have the 80% to sell and monetize over the coming years. But the focus is, this is a company we really believe in. We believe in the growth of this company, and we're in no hurry to exit completely.
Right. What can we look forward to in terms of the IPO pipeline? We did a story recently that, Lenskart has called for IPO pitches. I think Purple is also getting IPO ready. So can we expect more IPOs from the Kedaara portfolio in 2025?
I think you can definitely expect IPOs from the Kedaara portfolio, whether it happens in the first half of 25, the second half of 25, in 2026 is really something that we'll have to decide on to what's best for the company. We look at it in terms of an IPO, not simply as a monetization event for us, but is it the right thing to do for the company, for the promoter, and is the company mature enough in its own evolution that listing it will do the right thing?
How many of these companies do you think are at that stage from your portfolio?
From our portfolio, probably about, just to step back, we are investing out of our fourth fund. In our 3 funds that we have, so we have about 30 portfolio companies. In Fund 1 itself, we had 9 portfolio companies. We have IPO'd 6 of them. That's probably a record. And, the 3 others we had done strategic sales of, which, 1 to Warburg, 1 to a global strategic, 1 to Advent. If I look at a current portfolio now of about 22 companies, probably 4 or 5 of them are ready to be IPO'd from what's most important is the management team ready.
Right.
Are the financials and the processes of the companies robust enough to take in public scrutiny? When a company lists, you've got to make sure that for the new stakeholders, i.e. the new shareholders, you do an adequate amount of disclosure. So our governance, our disclosure levels have to be world class. And you've got to have, if there is, when we're a minority or a majority, a management team that can deal with the added pressure and the added time needed to deal with a public company. So I would say probably 3 or 4 of them are ready. We've got to probably tweak something on the, get a stronger CFO in a couple of them, get the move to a big 4 auditor in 1 or 2 of them. And that's all happening. The teams are doing the stuff. Then we've got to match that with the right opportunity in the market to see, hey, when do we actually list this thing? But there will be at least 4 that I can think of, a few names that you mentioned that will hopefully IPO in the next 18, 24 months.
Great. On that note, thank you very much for talking to us, Manish. Pleasure speaking.
Thanks.
Thank
Very
you.
good seeing you as always. Enjoy Davos.